I'd like to thank Beaufort for inviting me to speak today. I suppose you could summarise my CV in one phrase, and that is he's very old. About 30 years ago, a friend of mine called Frank Brown, who's got a PhD in biochemistry from the University of Oxford, and then started building software systems for quantity surveyors, because there wasn't a lot of biochemistry work going around. He invented a system for robotic block building so that you could form incredibly beautiful structures using a robot. And the robot ran on tracks, and you fed an AutoCAD system in the back of it, and you loaded it up with sand and cement and a bit of water, and it would automatically form the blocks in the right shape, lay them, and you could build beautiful arches and all sorts of things. He's still trying to get funding for that project. So when we talk about artificial intelligence in the real estate industry, it's pretty hard to find any sort of intelligence. It's worth also, I mean, you could think about Amara's law. That was a very interesting, the innovation cycle you told us about. The Amara's law is worth bearing in mind. We always overestimate the impact of technology in the short run, and we always underestimate the impact of technology in the long run. So trying to find your place between the short run and the long run is the hard thing in this world. You know, we know what's coming, we know what's going to happen, we know what the world's going to look like in 50 years' time, but what do you do in the next 5 years is the hard question. And it's pretty hard in the world that you're in, because we know that AI, which is all about, you'll get used to the ideas of trees and forests, by the way, decision trees, random forests, all this sort of stuff. We won't hear a lot about that in my talk. But the world of AI needs data, and it's pretty staggering to think that the UK doesn't even have a register of developable land. There is no national register of land. So if you don't have that sort of fundamental data, how can you really apply AI to this system? So you can talk about, I met a startup 3 or 4 years ago, a guy from New Zealand came over here, and he was raising money to invent a system whereby he used drones to fly over land, used GPS coordinates to measure the land, used planning histories in local authorities to optimise the planning that could come out of that particular piece of land and automate the entire thing from soup to nuts. I would imagine he'll still be trying to raise the capital in 20 years' time as well. Okay, so we know what's possible, but actually navigating the next 5 years is the hard bit. So I'm not going to talk about AI specifically. There will be plenty of references to it, but I'm trying to sort of do a sort of more general introduction to where we are in the world of tech. And I was lucky to write this thing called PropTech 3.0 3 years ago, and it just came out at the right time and caught everybody's imagination. And it's the only qualification I've got for talking about this stuff. I know as much about random forests and trees and all that stuff as you do. So we're all trying to work our way through the next few years. So we know that change is coming. You can call it bad news or good news, depending on your particular position. But we know that driverless cars are on their way. You know, they're going to take longer, a lot longer than we thought, but they're on their way. Flying drones, flying cars, robots, bendy buildings, all of that, we know it's on its way through 3D printing and so on. So we know what the world is going to be like in the future, I think. And it's easy to knock the property development industry and say that it's the least ambitious industry. So the world of medicine has changed somewhat in the last 100 years, but the world of house building has not moved on. And construction is often criticised as having the lowest amount of tech spend of any industry globally. So we know where we're coming from, we know where we're going to. What do you do for the next bit? It's probably worth putting ourselves in the context of waves of tech development as well. There was clearly a wave of tech development around 1998, 99, 2000, and that led to the dot-com bust, if you remember. So some of you will remember the dot-com boom and bust. And that dot-com boom led to a few survivors, very few survivors. You know, I remember a fund being raised of $200 million in the US called The Realm. It bought Argus. It went bust. It lost every cent of that $200 million. But Argus survived, CoStar survived, and out of the ashes came Zoopla and Zillow, and then Rightmove and Trulia. So we ended up with the house portals coming out of that crisis. But nobody cared about tech in 2003, 4, 5, 6. Nobody was talking about it because we were all talking about making massive amounts of money out of leverage and financial engineering. And all you had to do was buy a building and borrow as much as you could. Nobody was interested in tech. But quietly, the iPhone was invented in 2004. And the dot-com crash then led to the perfect set of situations where younger people didn't trust the system, didn't trust lawyers, fund managers, advisors, and in 2008 the iPhone was starting to get pretty well established, and we had this second wave of prop tech kicked off by people like Airbnb and WeWork and so on. And this idea of PropTech 3.0 is that it's the next wave. It's not the one we're in now, it's the next wave. And the next wave will be driven by AI and blockchain and a variety of technologies that we haven't really got to grips with yet. So we think we're at the end of the second wave of PropTech at the moment. So 2005 to 2008, the Big Short was the big news. We weren't really worried about tech, but the iPhone had been invented and the App Store was launched. And the App Store was launched in 2008. Exactly when the global financial crisis reached its peak. And then we end up with this beautiful formula where there are billions of rooms in the world and there are billions of people trying to occupy these rooms, but they've got no way of connecting. The connection used to be people called estate agents, and I see one or two in the room. You'll remember what that was like. It's a brilliant world, isn't it? Billions of rooms, billions of people, lots of fees, incredibly inefficient medium of communication between the two. But the App Store breaks that up. So you've got an app now which connects billions of rooms, billions of people. Airbnb is created, then WeWork is created, and then so on and so on. Anything, rent my storage space, rent my parking space, you name it. So we end up with in a different world, which is a tech-enabled sharing economy based on real estate. And the result is that real estate tech funding takes off, and it rises by huge amounts. And we know that there's at least 25 to 30 billion US dollars been invested in prop tech in the last 5 years. There are more than 6,000 prop tech businesses in Unisu's database in 100 countries. The UK is massively overweight in prop tech. You know, there are hundreds and hundreds of prop tech businesses in the UK. There aren't that many in most countries. We know that the impact of all of this is that the drivers of value have already started to change. We're getting new property types, data centres, rooftops are becoming interesting, not for mushroom farming, but for drone deliveries, flying cars. We've got dying property types, secondary retail, which is a pure tech phenomenon. We've got space as a service, so we've got this argument going on between hospitality and traditional office space users. We've got the climate agenda, so smart buildings, energy productivity, they're all big questions, big issues. And then we're getting new housing formats as well, because nobody can afford to buy a house, so we need co-living, co-ownership formats, and they're all to some extent tech-enabled. So PropTech 2.0 was this explosion. There are at least 25 PropTech unicorns already, including WeWork. I put a value of 15 billion on WeWork. I don't know, your guess is as good as mine. It used to be 47, but it came down a bit last year. Airbnb, the biggest, and several others. And you'll see in there that one or two of these are property development businesses like Katira and Procore, and I'll come back to look at those later. So you have this explosion of brands, but the sad news for some of us is that actually the number of prop tech companies that are being created every year has tailed off. So if you look at that bottom left chart, the number of startups has tailed off significantly in the last 3 years. But the amount of money going in continues to go up. So VC firms are investing more and more in a smaller number of prop tech companies. And so we're in the consolidation phase now. We're in the phase where the semi-successes, that's the best I can put it, are raising more and more money. And prop tech investors are looking for established businesses rather than pure startups, because probably all the good ideas have gone by now. You know, they're just 2 years ago, one of my old students came to me and said, I've had a great idea. What I want to do is build a tech company that connects all the buildings that are for sale with all the people that want to buy them. Hallelujah, that's incredible, you know. So the days were not that long ago when people could come up with that and think that's an original idea. But, you know, you would be laughed at now if you came up with that idea, obviously. So what is prop tech, and how do we define it? So there are several drivers. If you look at Contech as a space, it's a pretty small field, but there is a construction technology sector out there led by people like Katera and Procore. There's a legal tech sector out there looking at AI in legal documentation. There's a fintech sector, PayPal, online banking. And those are all stimuluses for prop tech, as is the big world of exogenous tech. So the big things that are going on, driverless cars, drones, the things that are going to affect cities, they're going to affect the world of property. And they are driving, construction technology is driving smart buildings and smart cities. So the impact of all of these movements, including data digitalization at the bottom, is that we've got three main prop tech sectors. We've got real estate fintech, we've got smart buildings, and we've got the shared economy. I'm going to focus on those three. And then in addition to that, I'll talk about data digitalization. The best way to make money in prop tech at the moment is just to do the plumbing, the engineering at the bottom, making the data work for you. That's the best way to get involved in this. And then smart cities is probably the worst thing you can get involved in, because that is 50 years away. The technologies go from web-delivered apps and phone-ready apps, which shouldn't be on this list. I mean, that should be on, that's like calculators, pocket calculators should be top of the list. But that tech is top of the list because property fund managers, for example, don't use it. It's you find a fund manager that sells units on funds or raises capital through a phone app. It just doesn't happen. So we are a long way behind in real estate. Then there's the big world of transport tech. There's AI, which we'll come back to, robotic cyborgs, virtual reality, augmented reality, blockchain distributed ledger technology and quantum computing, which are probably a bit down the road, sensors and controls, and then GPS and GIS. And all of these things are being applied in a variety of different formats by people in the prop tech world, creating this new industry. If you look at the sexy term, if you want to raise money, is definitely AI. And it's in the top right here. So the impact of saying you're an AI business leads to the greater probability of raising capital. So AI is definitely the trendy term. It's applied in a variety of sectors. So if I go back to my three sectors, the first sector is smart buildings, smart real estate. And this came out of, I think this originally came out of the need for energy efficiency and the sustainability agenda. So you will remember 10 years ago, we all had to say that we were interested in sustainability because we knew it was the right thing to do. We had no data that that told us that it was going to make any money or be the right thing, but we were told that we had to say things like sustainability. 5 years ago, we started to believe that actually it did make a difference and it would produce better buildings and even better returns. And now it's just a given. Okay, so the smart building movement is going through these waves of talking about doing the right thing, to collecting data to prove that it's the right thing, to being absolutely standard. And we're now going through the same thing in terms of wellness, well-being, productivity. And so smart buildings are all about making people productive, happy, and the reason that it's starting to bite is because the leases are getting shorter. So you've got what I call the bad old world of Hermes leasing an office building for 15 years to somebody and just washing their hands of it, to the great new world of WeWork, where you've got very short leases, you've got to keep your tenants happy and you've got to look after them. So that's a good development. All of this is good. The businesses that are going to dominate this are probably the bigger engineering businesses like Siemens and Honeywell. It's difficult to disrupt this market, but it's a really good movement. There's very little you can say that's bad about this. The people that are getting really stuck into the construction technology sector and helping to drive efficient construction and then efficient property management, Katerra has raised a lot of money. It's a $2 billion company. Procore's a $3 billion company. There's a VC company in San Francisco called Brick and Mortar VC who just throw money at construction technology. So there is a lot of movement in the development world from a pretty low base, it has to be said. Next thing then that we see is the occupier market. So moving from the construction operation of buildings to the use of buildings, WeWork is the big disruptor with Airbnb. This idea that we can share the use of buildings and that we are delivering space as a service rather than a long lease of a building that we don't worry about. It's pretty much encapsulated by those two pictures. When do you think those pictures were taken? Both at the same time, yeah, exactly. So the left-hand picture is an old Regis office, picture taken in 2017. And the picture on the right is a WeWork office from 2017. So the same year, the only people who like the office on the left are lawyers. You know, it has to be said. So there's this massive growth in buzzy buildings, and the great thing is that people are having to think a lot more about what makes a productive, efficient, happy space. Yes. And then we have a real estate fintech world, which is where probably most of the money will be lost and thrown away. You've got evangelists out there who think that the future of the world is crowdfunding, buying £1,000 of the shard, tokenization, blockchain, and they might be right, but I'd be very surprised if they are right. Right now, for example, last week there was an announcement that a building in Zurich had been bought with tokens. £120 million building in Zurich had been bought with tokens. It's just not true. I mean, they bought the building in cash, and then they're going to try and launch their token on an exchange. And if the token takes off, then the seller of the building will accept the tokens in place of the cash he's already paid or received. So there's a huge amount of hubris about tokenization, blockchain. But it's a beautiful idea. It's just a beautiful idea that we will have property passports, for example. This building will have a passport, a property passport, a digital twin, building information management, the whole lot, so that we can model this building using data, using computer simulation, and we can have predictive maintenance, everything that's driven by data coming out of the building. And that not only will the lights switch off when you leave the room, but you can adjust the temperature and everything according to the preferences of the people that's using the room. And then you start to get intelligence about which rooms are used, which rooms aren't used. You start to reconfigure your building and so on. So all of that is coming down the road. Real estate fintech is probably a while away in terms of creating these tokenized primary and secondary markets. In the resi market, there's a lot of chat about clearly portals are here. So 90% of houses in the UK, the sale of a house is generated by a portal, 90%, 5% through shop windows of estate agents, and 5% by word of mouth. So you've got 90% of the traffic being driven through these platforms. You've then got AVMs. Now this is AI, this is pure AI, machine learning driven valuation systems. And one company, House Canary, raised $50 million from one person, Eric Schmidt of Google, invested $50 million in House Canary. And the House Canary business plan is to model the value of every house in the US. And they're already claiming that in 90% of cases they can get to within 90% accuracy. And the trick is that 15 years ago we had things called hedonic pricing models in the academic world. But the criticism was always, well, how do you measure the value of a view? And in a hedonic pricing model, you can't. But in the AI world, you can, because you can measure the view using GPS and GIS. You can measure how big the view is, what the view looks like, and you can use AI to measure the value of that view. There's a PhD student at Cambridge that I met last week, and he is using AI to measure the appeal of a frontage. So there's what do you architects call it, where there's a Georgian building has the perfect ratio? The golden ratio. Okay, so if you take the golden ratio and expand that and expand that and expand that to what human beings like, you can start to use that in valuation systems as well. And now most mortgages are generated with valuations that are generated by computers. So the valuer is already losing work to computers in residential mortgage valuation. Then you get companies like Open Door and Nested, so iBuyers, who will buy houses. So that they will use AVMs to value a house, and they will make you an offer of 90% of the market value, and they'll buy it in 7 days, 5 days. So we now have automated house purchase. And the ultimate that people are thinking about is a sort of an instantaneous transfer system where you've got all the data about the house, including the valuation. The valuation is put on an app. You want to go and live in a street, you can get the value of any house in the street, and you can make an offer directly to the purchaser, to the owner, sorry, without having to go through a portal. and without anybody having to put the house on the market. So I got a letter through my door 3 days ago. We're looking for houses in your area. Would you consider selling? Well, in 20 years' time, that will just be an email backed by the valuation of my house, and they'll know what it's worth, and I'll know what it's worth. And there's no point in haggling because the computer knows what it's worth. So instantaneous property transactions won't happen because people are going to be doing lots of due diligence to make sure they'll still be paying lawyers because they are spending too much money, and caveat emptor is the ultimate killer. So until we create an insurance product which insures everything there is about the house so that the buyer can take the risk, then we're going to have pretty slow transactions. And we still don't have digital data. And the land registry is not digital. It's worth bearing in mind. The land registry works on the system of general boundaries, so it doesn't know exactly what your boundary is. It just assumes that we're all nice people and that we've negotiated it between ourselves. If they digitalise the land registry, the number of disputes we'd have between neighbouring landowners would be so much that you just couldn't take the risk of doing it. The easy way of getting into the PropTech world is to work on data analysis or data visualization. There's a lot more data being generated. Companies like Guyana are able to use mobile phone data to work out how many people are in any pret-a-manger at any time, how many people have been in any pret-a-manger. They can tell you which one's going to generate the most traffic, and they can then tell you where to put your retail space and all sorts of things. So there will be more and more data, but we don't have systems that are compatible with each other. So lawyers use data storage systems which don't talk to surveyors' data storage systems. And an example of an AI business, Proda. Proda is crawling over dead data, PDF data, and grabbing that data and put it into an intelligent form and trying to guess what that data is in order that it can automatically then assemble tenancy schedules. So tenancy schedules often have to be retyped in a transaction. If you're offered a building, you're often given something dead that you have to retype into an Excel spreadsheet. It's crazy, but AI will solve that, and that's the nuts and bolts of AI and property tech at the moment. Then the thing that can't happen for a long time is smart cities. We talk about them. It would be brilliant to have them, but I tried to, last week, what did I have to do? I had to go to Wallingford, which is near where I live, to pick up something. Then I had to go to Didcot for something else. And my car was in Didcot, and I was trying to pick it up from the garage, and I tried to use buses to get from where I live to Wallingford and then to Didcot to pick up my car. You try finding out online when the buses are running. It's unbelievable. We talk about smart cities, but the bus timetables are PDFs, and you just cannot. So we're a long way away from smart cities, and cities don't have any money anyway. So smart cities are a long way away, unfortunately. Cities need investment. They're not smart, and there's a real financing problem with smart cities. Winners and losers. The picture on the right was, I took that picture on the tube a couple of weeks ago, and it says, "I hear you lot are into buying experiences. Yeah, we'd quite like to experience what it's like to own a house." Massive overstatement of the sharing economy. Young people don't want to share space. They want to buy their own house. The reason they share space is because they can't afford to buy their own house. So there's a lot of nonsense talked about experiences trumping material possessions. This is just a phenomenon of the current generation not having much money. But when my generation starts transferring its wealth to the generation below, you'll find that all of a sudden they're very interested in buying houses. So it's overhyped. The sharing economy is overhyped. Co-living, all of that, overhyped. Cryptocurrencies and ICOs have been overhyped for 2 or 3 years, and they're on the way out, thankfully. Syndication, tokenization of assets, I think that's a long way away. Smart cities I've already talked about. Understated is smart building technology, which is well worth investing a lot in because it's going to pay off. And then the digitalization of data for new assets. Any new building should have a property passport, a digital twin, and then that will lead to the opportunity to do all sorts of things through AI and automated valuation models. And then the big unknowns are blockchain. We just don't know whether the world will jump into a blockchain world or not. And I would bet on it, but it could be overtaken by other technology before it's adopted. So you'll read plenty about blockchain. and there are plenty of people promoting it. So the good news is that change is coming. I see it as good news. We're going to see smart buildings. We see space as a service. We see some real estate fintech, which is, some of it's going to work, not much. Data engineering, so the nuts and bolts of getting your data to work, and then smarter cities eventually. What are real estate people doing? A variety of strategies, from standing back and letting the world letting the world work itself out, which is a very wise strategy. If you go back to Amara's law, the impact of technology is overstated in the short run and understated in the long run. It's pretty wise to stand back and carry on. So when people attack you for being conservative, boring property people, just smile and think I'm doing the right thing. Although you should be thinking about your data. You should be organising and visualising all the data you've got, and thinking of ways of pooling that data with other people without losing control of it. And certainly don't give the ownership of it away to anybody, but think of ways of pooling it. And all of that might justify having a chief digital or a CTO or an innovation officer. I made the mistake in Norway last week of saying that everybody is trying to appoint a chief digital or a chief technology officer in the property market, but they can't be very good if they're working in the property market, can they? And the room was full of CTOs. Didn't go well. You might support an accelerator. There are 2 or 3 in London, Concrete, Pi Labs. You might invest in a prop tech fund. The economics of prop tech VC funds are scary. If you get 1 in 10 right, that's a success. Success is defined as the company raising more money, not making a profit. So you're very wise to go back to the top line there. There are people forming associations to learn about this stuff and to pool their information. And some really great companies are supporting research into innovation and strategy, and they are my 9 sponsors, so I'm very, very grateful to those people. Next month, the follow-up report's coming out called PropTech 2020, The Future of Real Estate. That'll be launched in February. If you go online, you'll be able to find it next month. And thank you very much to Beaufort for asking me to speak. Thank you.